Are you looking to make more money on your covered calls, almost doubling it in some cases, and taking on basically no more risk? Then today is your day to meet the Jade Dragon. Greetings, and salutations to all my brothers and sisters out there. I do welcome you in today for a very special time. This is a bit of an educational piece, but it's about the Jade Dragon. And before we get into it, look, I already know that I didn't invent the strategy. I didn't make it up or anything else. I just thought it'd be a clever name to remember it by. There is nothing new under the sun. You can only buy and sell puts or buy and sell calls in any form of those, and it's been around for decades, so we're probably not coming up with a new strategy. But this is the Jade Dragon, as I like to call it, and it is a derivative off of a reverse Jade Lizard. And if you don't know what the reverse Jade Lizard is or Jade Lizard is, I recommend that you look it up. But what we're going to do today is look at stocks that we already have 100 shares of. 100 shares of stocks will give us the ability to run covered calls to create more income. It's almost like a nice dividend that you get to run these covered calls on the stocks that you already own. You collect the premium and you do this repeatedly in and out all the time. It's also part of the wheel strategy in which you are running puts on something, you get assigned on the shares, and then you turn around and start running the covered calls on them the next week. Covered calls are a great way to find a great premium source, and it's very lucrative and it's a lot of fun. So today we're going to look at the Jade Dragon, which takes your 100 shares of covered calls that you're running already doing it, but we're going to couple that up with a put credit spread. Now this is going to differ from stock to stock, but one that I really recommend that you might look at doing obviously if you own the stocks now, fine, but start running puts on Rigetti. We've already been talking about Rigetti. It's a subject for a different time, but Rigetti and the quantum stocks are going to be great right now to run these puts on. They don't exactly fit the format of our traditional put plays to where you wait for a base or a bottom or some kind of line in the sand to where you start getting in, but rather these are stocks that are going up and we're getting in puts as the stock's going up. Kind of counterintuitive, but if you know a stock's going to rise, it's an excellent time to get in and get out on short-term puts. Nevertheless, you've got your 100 shares of stock. You're selling your covered call. You look on the other side of the fence and you sell a put credit spread that is going to bring you more premium. Now, basically, one of these two is always going to win. The one side or the other has to win. The stock's either going to go up and test your call side, or it's either going to go down and test your put credit spread. Either way, it's fine, because if one gets tested, the other's going to make up for it. So it's a very, very, very low buying power risk trade. This will keep your buying power low and your premiums coming in nice. So let's say you usually collect $50 for a premium on a stock that you're running your covered call on. If you put that put credit spread in addition to that and run this Jade Dragon on it, you're going to find that you're going to be making $80, $90, $100 on this same stock. And what you're basically looking to do is just keep that stock in between. You need it to land in between the put credit spread and in between your call. So if that happens, boom, they're both winners. Everything's good. You collect all the premium. If it trucks around in there for a couple weeks, depending on the length of your play, you're going to gain theta in this play, and you can be able to buy it back at a cheaper price. Once again, net win, boom. So if one side or the other gets tested, that's perfectly fine. Again, the buying power is super low, so you are doing a great move there in preserving your capital. You're going ahead and you're running the same strategy that you were already running, putting basically no more risk onto it, but what you're going to be able to do is supercharge the premium profit that you're getting. And you're going to be able to run this over and over again. Low-cost stocks are fantastic that are at a bottom. If you find something like an Archer, or you're looking at Joby, or some stock that's reaching a low. SoFi is another good stock that's kind of went down, and we're kind of looking at the financial industry anyway. But there's an endless amount. RCAT, for the drone industry. But nevertheless, get in there. If you're starting by running the put, that's fine. Keep running your naked puts on a stock that you don't mind owning or don't mind running the wheel strategy on. Perfectly acceptable. Then once you get assigned, because you're going to get assigned sooner or later, then we're going to turn around and we're going to start running this Jade Dragon strategy on it, and you're going to be amazed at how much better your profits are. Now, yes, you do add a little bit more risk and there's things involved, but it's minimal. But the best part about it is the buying power relief. You know the stock, you've already bought it. You've already been running puts on it. You got into the stock and now you've owned it for however long. So you're obviously familiar with the stock. Well, use that to your advantage. If you're a chart person, look at your charts, find your support levels and all these kinds of things. If not, just go and run a 20 delta put credit spread. Your 20 delta will be in the range that about you want to be, somewhere around the expected move, just under, and then do the same thing for your call. If you want to get out of the calls, put them down a little bit closer to the strike. If you want to hold on to the stocks a little bit longer, well, move them up a little bit longer and run them week after week after week. But what you want to do is just not run the covered call by itself. If you're running the covered call by itself, you're leaving money on the table and you're using more buying power that you may not have realized that you even need. It depends on your portfolio. Sometimes you're even going to have to use buying power to run covered calls. It's just the way it works. So, but you're going to make more money, and that's what we're all here for, right? We're here to make money. We're here to make more money. If we can make more money off doing the same thing we're already doing, adding basically no more risk and reducing, our risk factors overall to the portfolio, absolutely, that's something we absolutely should be doing. So go in there, look at your portfolio. I don't like to do a lot of portfolio things and charts and all this stuff to make it seem cool. You're basically just running a cover call and a put credit spread. Get into your platform and see what that looks like already on 100 calls that you own. And if not, just look at how it would look anyway. If you have the ability to paper trade on that, just look at it, paper trade it for a while. And this is a nice thing that you can go out 45 days as it's sometimes recommended, or you could run it for 2 or 3 weeks. It all depends on the volatility in the stock and what you're doing. So there's a lot of factors that go in. So there's no one right answer for it. But get in there, run your cover call, put your put credit spread against it, make extra money, and enjoy the Jade Dragon. And coming soon, we're going to look at exactly the same kind of concept on some other trades. So you don't want to miss those either. I appreciate you tuning in. Thank you for hanging out to the end. I hope your portfolios get tons of cash this week. Keep watching those quantum stocks. Use Rigetti as something for both of these things that you can do. And we will catch you next time on Trading in Your Future. Have a great day.